Hi everyone, thank you so much for joining us today. My name is Brian Eng. I'm the Chief IC for Australia Properties in PropNext Singapore. Now in PropNext Singapore, we aim to bring the best projects to you, but beyond bringing the best projects, we also believe in bringing the best service providers. So when you're working with a PropNext agent, usually what you will get is we will be working with service providers who are very experienced, who have been in the business for a very long time, and certainly have seen everything that they need to know to help all our buyers and agents moving forward. So today, we're very glad to bring off one such experienced service provider. His name is Mr. Albert Chua, and he is the tax partner for GC and Associates, and he has been helping a lot of clients over the past 30 years and has helped many Southeast Asian clients, including Malaysians, Bruneians, and especially Singaporeans with their tax matters in relation to their property acquisition in Australia. So without further ado, I thought it would be great if we could get Albert to come online today and share a lot of his experiences via a text presentation to help our buyers and agents to get an understanding of some of the key basic information and facts that they need to get sorted out right from the start. So with that, thank you so much again. And Albert, over to you.
Yeah. Thank you, Brian, for your great introduction. It's always good to be associated with yourself and obviously your company being PropNext in Singapore. So like what Brian said before, I have actually more than 30 years of experience in this particular area. So our area of expertise is, other than accounting, we deal with GST, and obviously income tax become very part of our business, in particularly servicing clients from Singapore and the rest of the Southeast Asian countries such as Malaysia, Brunei. And we have clients from Hong Kong and China. So the key things about today's so-called presentation, as Brian has pointed out to you, is investment in Australian property is such a big so-called part of our client base in terms of dealing with clients on day-to-day issues such as how to deal with tax compliance, such as lodging tax return, also helping client with their advice in situations such as capital gain tax. Client often come back to us and say, "Wow, what if I want to do this, do that? So what are the tax implications?" Now, today, what I will do is I'll do a couple of the very important slices of information that is always been presented to most of our clients in Singapore. So often I do the road trips in terms of attending expos, doing presentation, and one-to-one meeting with the client. So today is no exception. So I'm just going to share a couple of pieces of very important information where clients, before they embarking on this Australian property investment, what are the things that they need to know, and what are the things that they need to be very, very careful with. And also at the same time, looking at some of these key issue or key item they should be looking at when they invest in Australian property. Now, just in front of us at the moment is there are a couple of important information, but some of this information are information that you most likely already know. It's again, Australian property has been very well known for one of the best investment, what you call asset class, that offer various type of attractiveness, such as easy to gear. So basically you can get finance for property, but again, ongoingly, whether you're going to get finances onshore, offshore. Onshore means that in Australia, or offshore means that you may be able to get it on your home country, whether it's in Singapore or Malaysia. Now, obviously, a lot of my clients at the moment, I think we have close to over 2,500 clients from Singapore, and they look at buying Australian property for basically a couple of reasons. One of the key reason that they're doing that is looking at property in terms of capital growth. All right. Now, when you talk about capital growth, you're talking about increase in property prices, and therefore often people leads to that question is, so there's a capital growth. Do I have to pay capital gain in Australia? Now, I know in Singapore there is no capital gains tax, but in Australia it's very different, which I will go through that in a bit more detail a little bit later on. Yes, we do have a capital gains tax in Australia. Therefore, capital growth, does it convey to capital gain and therefore capital gains tax? And that's something that we can discuss. Now, obviously, the other reason why clients buy in Australian property is they're looking for rental income. Now, that leads to the other question is, so if I receive Australian property rental income, so what do I have to do? Actually is a reportable so-called transaction, meaning that you need to file your tax return on a yearly basis, because if you receive rental property income. There are other things that you need to be very aware of when you invest in Australian property. So one of the things that we often tell clients that, look, there's a lot of implication as a result of property investment in Australia, but you also got to look at the positive side of things. All right. So the positive side of things meaning that what benefit or what tax benefit that are you entitled to as a property owner when investing in Australian property. Now, obviously, one of the key things that we always flag, probably a couple of things, which I will go through a bit more details, including tax depreciation, okay? And then interest costs. Are you allowed to claim tax deductions on interest for your borrowing? Obviously, the answer is yes. Now, the other thing that often people talk about in terms of Australian property is that, oh yeah, we heard from our friends or colleagues that there is this thing called negative gearing, often talked about in Australia. So I'll explain a little bit about the concept of negative gearing and what does it mean when you say, oh look, I'm actually negative gearing my investment in Australia. So what does it really mean? So there's some tax implication that you need to be aware of. All right, then we talk about offsetting, meaning that can you offset losses against income, or you can offset future income against the carried forward losses. So these are the things that we also talk about. Then obviously, importantly is, can I offset capital gain? Meaning that if I make capital gain from one asset, can I utilize the losses previously that I have made losses on by selling the other property previously, which I have a carried forward capital loss? So we'll deal with all that issue today, all right? Now, there's a couple of things that I think is very relevant in terms of trying to understand why all this tax complying with the Australian Taxation Office are so important, all right? Now, let's go through a few facts that, I put together over, I suppose it's the last 20 years during my 24 year, if you think about it. So I started my business by traveling to Singapore as well back in 2000, maybe a little bit earlier than 2000. So it will be 24 years now, is to educate property investors when you invest in property. So obviously, what does the local authority in Australia look for when you become one of their so-called property investor in Australia? So things like they look at capturing all your information based on the data that they have collected over the years. And you'd be quite surprised at the amount of information that they have on the individual, as well as company, as well as trusts, or a various form or shape in terms of structure, in terms of property ownership. Now, today we only focus on individual property investors. All right. Now, as you can see in front of you, the so-called presentation slide is about over 2.273 million individual. We haven't talked about any other structures such as trusts, company. We're just dealing with individual today. Now, all of that 2.273 million of individual property investors, there's approximately about $50 billion of rental income being reported. All right. Now, again, that's a good number. Okay. Well, I'll show you a bit more in terms of how this $50 billion become $50 billion over the number of years. This, I think, will be over 20 years of the information they collected. Now, at the same time that they also have these reports coming out saying that, look, well, out of that $50 billion of rental income being reported, there are $44 billion of rental deductions. Now, when we talk about rental deduction, we talk about, tax deductible expenses. That's what it is. All right. Now, for the year 2021-22, meaning that 1st July 21 to 30th of June 22, our financial year in Australia is July to June. All right. And the net amount, as you probably already work it out, 50 minus 44 is $6 billion of profit. We call net income. all right, meaning it's positive. Now, importantly to know that, over the years, which started in 2000, just coincident that now is like, 22 years of reporting, collecting information from various property investors, individual investors. Over the years, as you can see on the graph, that there is already increase, at least starting from 2000, that they start collecting data. I think they collect the data much, much earlier. I believe it was back in 1996. All right, they start collecting data about taxpayer, all right, income, expenses, what is the net position. So they've been doing that all along for the last, I assume that it's like 30 years, right, or 20 odd years. All right, now over the years, property investors has increased over time. So the property becomes a very, very popular so-called asset class, all right, in Australia for individual property investors. Now, along come with the property investor, obviously, you can also see that the income has increased over time. All right. Now, then it just start growing. It's growing and growing. I mean, last 22 years, based on what's in front of you at the moment, you can see started above 10 billion. Now it's like a $51 billion industry or investment. All right. It's a very big pool of investors, and it's also got a lot of potential in terms of income. Now, often people ask me and say, look, well, what does it translate to? Like we know the gross income. So what is the net income? All right, which is, gross income minus deduction equal to net income. Now, as you probably can see in front of you at the moment, all right. Now, up to 2020, all the while, the net income position, it's always been, all right, negative. All right, always below the zero line. All right, meaning that it's negative. What does negative means? Negative income mean? Negative income means that you don't pay any tax as a result, or the taxpayer or the property investor don't pay any tax as a result of negative income. Now, only the last 2 years, I think that's during the COVID time, post-COVID, 2020, 21, 2021, 22. I mean, we start seeing positive income. All right. Look, this is the sign is what's happening at the moment. I think next few years is going to be the same. We already start working on we have completed the 23 tax year. We have now started the 24 tax year. And I can tell you that a lot of my clients are experiencing a lot of positive income coming out from their rental activity or their rental property, as so-called, right? Now, this trend will only continue. Now, if I put that two together, as you can see, more income, there's supposed to be more, most gross income will be likely to be more positive net income, but that's not the case up to only 2020. All right. Now, after that, you can see that it's happening now. It's in terms of potentially people will be paying tax. Now, what I want to do is also to show you not just the gross income side of things, is to start exploring, all right, and what does these people claiming in terms of that $44 billion of deductions. So I have break it up, all right, in terms of for the 21, 22 years, in terms of what are the majority of expenses they so-called claim in the 22 tax year. All right, as you probably can see in front of you that this chart break up all the expenditure, which I'll give you the number a little bit later on. The biggest portion of this is obviously interest on loan, meaning that they borrowed money when they purchased the property, borrow cost of financing, all right, interest on loan, all right, it's about 36% of the $44 billion. So the other item that is pretty big on this is the depreciation and building write-off. Now that's 14%. All right. Now I'll give you the number so that it makes a lot more sense. So we put it together, that $44 billion of deduction, what does it make of? All right. So as you can already see, that depreciation, the loan, the interest on loan are the biggest chunk of this whole $44 billion. Now, what does it mean then? Meaning that these are the two things that you got to do. All right. As a property investor, you got to look at your financing options. All right. And you got to look at what are your entitlement to claim depreciation and building write-off. So these are the two things that you need to look at. All right. Among other things are also very important, such as land tax you can claim, which I'll cover a little bit on that. And by the way, Brian asked me to actually spend a bit more time talking about this land tax. Now it's become quite a big issue among property investors, especially foreign property investors. Now, I would briefly go through this couple other slides, and I would pause and make some comment. But I think if you read it and you probably understand, like this one in front of you is where does most of the property investors invest in? All right, I mean the three big states, the three biggest city in Australia is Sydney, being partly is New South Wales. You have Melbourne, which is Victoria, Queensland, you have Brisbane, Gold Coast. Now, these are the three major states in Australia, being New South Wales, Victoria, and Queensland, where most of the people are investing in. All right. I mean, I suppose that these are the three biggest states that where most of the population are in at the moment. So this one is just give you a bit of understanding in terms of positive income or neutral, meaning that break even versus losses, by states. All right. The next one is obviously talks about the dollar value in terms of the earlier slides. It's still, again, the three biggest states being New South Wales, Sydney, Queensland, Brisbane, Gold Coast, and Victoria being Melbourne are the so-called the front runner, all right, in terms of that. Now, the next slide is probably something is a bit more relevant to the foreigner or the foreigner investor, being called number of non-resident property investors in the Australian individual owner property market. Is you probably can see that there is a huge number of property investors coming in back in starting from 2008. I have clients that has been with me for the last 20 years coming up from Singapore. So they're probably in one of those numbers there. But again, it's not a huge number compared to the local investor. You think about it, 2.0 million property investor, you're only talking about sub 200 being foreigner. So foreigner always been portrayed as the so-called the influencer or the person that is going to shake the market. And that's all wrong. The newspaper often say, oh, we have foreign investors coming in that impact our property market. They are the one that is not renting out a property and so on and so on. Actually, it's not quite true. Foreigner makes up a very small portion of that pool of individual property investors, 10% or maybe less. All right. Now, I give you this next slide is because I want to show you the difference between resident investors and the non-resident investors. You look at the amount of taxable income as a resident, all right, in terms of property, all right. So resident is huge, over net income of over $1 billion. The non-resident are so small amount, all right. And look at the amount of tax that resident had to pay compared to the non-resident. So again, whatever the newspapers portray are not quite correct. All right. Now, these next slides give you all these numbers again, in terms of gross income, all right, interest deductions. And you can see, all right, resident, they borrow a huge amount of money, all right, for property investment purpose, all right, in terms of the net income as well. So again, foreigners are not the main cause of so-called shaker or mover in the property industry in Australia. It's actually not quite true. All right. Now we move on to something that I think we should talk about. It's this thing about negative gearing. All right. Often a lot of clients ask me, say, look, what can you explain what this negative gearing is all about? All right. So there's only one thing that I can explain it, and I explain it very, very simple, is that negative gearing is an event that where you own the property, okay, the income or the expenses or the cost of running the property it's actually more than the income that you receive, right? So basically, its expenses is greater than income, all right? It's mathematical term. So as a result, you create this negative effect in terms of the investment, such as property, all right? So negative gearing not necessarily apply to property. It could be applying for share trading where you may be able to get finance in terms of share trading, but I often don't get involved so much in the share trading side because majority of my clients are in property. So a lot of time when people talk about negative gearing, they often refer that back to property. All right. Now, as a result of this negative effect, there's no tax implication. All right. No income tax payable when you have a negative situation. So obviously, on the reverse or the flip side is called positive gearing. All right. Positive gearing means that you have positive income. So income more than expenses. So likely that you have to pay tax as a result of that. Now, that's where it brings to all these things come to discussion is what are the things that you need to look at, okay, when you want to have what we call a very effective tax planning when you deal with property investment. So what are the things that you need to look at? So I have the next couple of slides that I think is important for any property investors, especially as a foreigner, all right? What do you need to look at, all right? So first thing first, you got to look at how to finance, all right? How to finance. Finance could be in any form, meaning that you can go out there to the bank and pledge the property, borrow the money, and invest. Or finances could be financing out from your own pocket, meaning that often people refer to coming out with your own equity. So what tax implication has? So these are the important point is how do you finance? Are you utilizing the negative gearing, okay, concept, meaning that you go and borrow. All right. So therefore you borrow. So you increase your cost of maintaining the investment, meaning that you have to pay interest on the borrowing. All right. So you create this scenario that the earlier on the deductions issue is that you have this 30% of borrowing cost component within your expenses of $44 billion. And that creates the negative gearing. Or obviously, because of negative gearing, you create a loss. All right, you have a loss structure, loss situation. Expenses is more than income. You don't have to pay any tax. So that's effective. All right. So the other thing that I often tell people to do is to look at, all right, optimizing your borrowing. All right. People often ask me, how do you do that? What do you mean by optimizing? So what I always said to the client is they often ask me this question. They say, look, Albert, if I want to buy a property, all right, how much should I borrow? All right. Do I borrow 50%? Do I borrow 40%? Or do I borrow 60% or 70%? I often said to them, look, you always have to look at optimizing your borrowing. All right. Now, banks know what's best, or bank understand the market much better than we do because they employ so many so many experts sitting on their board, and they have economists, they have specialists that advising them what the market direction. So they will set what they call LVR, meaning that it's like a loan to valuation ratio, meaning that effectively what they're saying to you is that they can lend you a certain percentage based on the value of your property, and that could be 65%. At the best of time, I can see 70 to 80%. All right. Now, I often say to the client, look, optimizing your borrowing, meaning that you will borrow as much as what the bank can lend you. Very simple. All right. If they say, look, while policy says we can only lend you 70% based on the valuation or based on your contract price, you borrow that much. All right. Now, I have a reason for doing that. All right. I often said to the client, look, if you don't do that, all right, say for example, the bank's offering you to 70%. If you don't do that, you say, oh, look, I only need 40%. All right. and you went ahead and settled the property and you only borrowed 40%. All right. Now, then you might find out later on and say, look, wow, look, 40%, it's a bit too much coming out my own money. Now I need my money, part of my money to do something else. Now I'm locking 60% of my equity into the property, borrow 40% of the bank loan. I like to increase it. All right. Now, if you're going to do this refinance position, all right, in terms of extracting your equity, which I talked about in point 4, mean avoid refinancing to repay your equity, means that you refinancing in order to get your own money back, and that's not good, because effectively the effect is irreversible, meaning that if you're going to refinance, say for example, instead of 40% become 60%, that 20% refinancing, by putting it back as your own equity, you could lose the deductions on the interest. All right. That is not the position that, I will advise my client to be in. All right. Now, not unless you said, look, well, from 40%, I want to increase it to 60%, that 20% equity extract, I want to buy a second property or a new property for investment purpose. So yes, you can do that. All right. But repayment or repaying equity, you're going to lose that deductions, and no point of doing that, because effectively it's not very tax effective. All right. Now, in terms of point number 3, to avoid bank offset. All right. I do know there's a lot of bank likes to do all these things. They say, look, well, we're going to offer you, say, $200,000 mortgage to buy a property. All right. Maybe that's a wrong number. Let's say 500,000 to buy an $800,000 property. All right. And we're going to set up an offset account separate to the loan account or separate to the operating account on the daily basis. This offset account is set aside so that you can put a bit of your cash in it. And say, for example, loan is 500. You put $200,000 in the offset account, meaning that the bank will only charge you interest on the difference, meaning 500 less whatever is in the offset account, 200,000. They only charge you interest on the 300,000. You might say, look, that sounds great, Albert. I'm saving this interest. All right. Now, you have to think like this, right? If you're doing that, you might as well pay off the loan from 500 down to 300,000 by using the 200,000. Why don't you do that? Because it's not very tax effective. All right. So offset account is something that I always tell the client to avoid. I say, look, unless you have every intention to take the money in the offset account and reduce the loan completely, in this case, the 500,000 being reduced by $200,000 in the offset account, you only left with 300,000. That's fine. All right. You can do it that way. But if you want to make sure that you optimize your borrowing, you got to keep your loan at 500,000. You may choose to pay it down, P&I, principal and interest, and reduce it over time. But leaving money in the offset account in the shorter term is actually not a very good idea. All right. Now, I often advise clients not to do that. There's also another reason not to do that, is because from my experience, the Australian tax office actually track your year-to-year expenses, including interest, all right, the borrowing costs. Because you know why? They need to know if you are embarking on a long-term property investment, you should be paying down your loan over time. You can choose to pay interest only. So your interest expenses will be flat every year, will be about the same amount. But if you are on this journey about reducing your principal by paying principal and interest over the year, so your loan should be sliding down like this. Imagine that your loans are your interest cost is not sliding down like this. It's like fluctuating up and down because of the offset account. That attracts a lot of unnecessary attention from the tax office. They do track that. That's why how I get all those figures over a number of years in terms of expenses, in terms of income. That's what they do. All right. Now, things that you do not do. Those are the things that you don't do. All right. Now, the next slides that which I have earlier on mentioned about is this tax depreciation. Now, often client ask me this question, which is quite a common question. Is like, this tax depreciation you're talking about, Albert. I know we are entitled to claim it under, the tax rule in Australia. All right. Do I do this tax depreciation report every year? I said, no. This tax depreciation report, you need to do it once. That's it. For one property, once. All right. Meaning that if you own a property, say this year you settle it, you engage a QS, all right, a quantity surveyor to do this, to prepare this. It costs you, say, anything from $300 to $500. That is a one-off expense. Now you need to do it once for one property, all right? And this report is very specifically for your property, not for any other property. You do not accept a one-pager from anybody, including your sales agent or the developer, and say, look, this is the depreciation report. It's a one-pager. You just use it. Now, the report should be at least, all right, it's a very thick report. Some report, I've seen it, 20, 30 pages long. All right, very detailed in terms of, what are the building, what are the costs of the building, what are the fixtures and fitting, what are plants and equipment inside the building, what are you entitled to claim, item by item, 20, 30 pages long. All right, I've seen it. Again, one-off investment, which is important. Now, I will leave you these slides here for you to read up. All right, now, this is slightly, maybe a little bit old, maybe about 2-3 years old, but it's still very relevant, just to give you a guideline in terms of what if you buy a 2-bedroom apartment. I think now average 2-bedroom apartment in Melbourne now is already more than $750,000. All right. It's impossible to buy anything with a 2-bedroom apartment in Sydney for $750,000. I mean, they're talking about over $1 million at the moment. The last I spoke to Brian yesterday, he was talking about $1.2 million for a Brisbane 3-bedroom apartment, something like that. So these are a bit old, but it's still very relevant. It just shows you that for which particular investment that you are embarking on, whether it's an apartment, whether it's a townhouse, whether it's a residential house, what are the so-called tax depreciation benefit that you can claim for the first year, and accumulatively for the first 5 years, what you can claim. Now, remember this tax depreciation benefit that it's actually counts with the ownership of the property. You own the property, you're entitled to claim. Now, often people come back to me and say, look, well, Albert, is it I must do it, or is it mandatory I must claim it? I say, look, you have a choice. All right. By law, you're supposed to claim it because you are entitled to it. You should claim it. What's the reason to claim it? Because you can reduce the amount of tax that you have to pay. Later on, when I start showing you the income tax that you may have to pay if you choose not to, number one, claim the tax depreciation, or potentially forgone your interest deductions because you choose not to borrow some money from the bank or finance, you can start paying tax, and you can understand why I will encourage you to at least look at depreciation, maybe not borrowing right to the maximum in terms of what the bank can lend you. I mean, no point going, around and say, look, well, I want to borrow 100%. I mean, I still have client doing all that 100% finance. All right. Now, client do all this 100% financing is because they probably already have maybe 2 or 3 property that are at the stage that nearly pay off, and they decided to buy a brand new property. It could be the 5th or the 6th property. They said, well, we can extract all the equity among the 4 or 5 property and to pay full cash on this one. Because why? They are trying not to pay tax or try to be a bit more efficient in terms of their tax. All right. So these are quite common question. Again, are relevant. All right. Now, there are other things that you need to be very aware of in terms of achieving some what we call effective tax planning. All right. Now, I often look at this ownership structure. Now, it's very important. We need to understand why the client do property investment. All right, there are various reasons for doing property investment, meaning that they may want to share some wealth. Property is a good asset class that they can capture their wealth in it, and it can grow. All right, and it can just live there, collects the rent. So it's a passive, right? So at the same time that we often talk about ownership, all right, why is it important? Then we talk about whether it's ownership between the husband and wife, is it the ownership between the parents and the children, and how that's going to be best structured. So we have a lot of client has various form or shape of ownership. All right. So our very common one are, joint ownership. All right. Meaning that husband and wife, joint ownership. All right. It's quite straightforward, right? So not just is tax, there's also other things that you need to consider in terms of that ownership structure. All right. Say, for example, why choose a joint tenancy? Okay. Husband and wife, it's fine. Passing on the assets upon one death becomes automatic. Now, automatic doesn't mean that it's the title will just change hand. All right. There are certain things that you need to do in order to effect, say, for example, husband and wife situation, husband pass away, how does a wife would entitle that 50% ownership to a joint tenancy structure from the husband. All right. So all these things you need to talk to your lawyer about what's the best way to structure this. All right. Obviously, I can be involved. Now, the other structure that we often hear about is this tenants in common. All right. This is very common amongst friends, even brother and sisters. It could be very likely to be friends. I think friends is probably something that we would say, look, wow, let's just co-invest this property together. We'll have a tenants in common structure. You control your 50%, I control my 50%, or you may have more than two, you have a 30, 40, and 4, and 30. So that will be most likely in the tenants in common structure. So you entitled to your own what we call interest in the property upon your decease. That ownership get passed on based on your will, okay, or where you want to direct that to. Now, why we talk about that is because it has this tax implication as a result of that. All right. Now, why we specifically bring this up now is I often remind client is while it's okay for you to mix your ownership structure, all right, but you also got to consider, all right, things like depreciation. I think importantly is things like borrowing, all right, and therefore losses. All right. I talk about that is because I see clients make a lot of mistake when they do something like this without proper consultation. Is when they start looking at investing, they look at their financing, whether it's equity, whether it's through bank finance or other arrangement. They often get it wrong. It's because once they get it wrong, the flow through of this net income, whether it's positive or negative, and therefore the tax implication or the tax effect of that could have been not very well managed. All right. Now, same, not just the net rental income, same for capital gain. All right. We haven't talked about a lot about capital gain, which I'll cover a little bit at the end. It's so important this structure are being looked at, consulted, and form an opinion in terms of what's the best way to do this. I mean, obviously that you don't want to have a structure with a minor. Okay, when you say minor, anybody under 18, all right, under Australian law is considered as a minor. Effectively, that minor cannot really become a legal owner of the property, and that's where you got a bit of problem, and how they've been taxed is probably another issue. But as a general rules, you got to look at all that. You got to look at who is your co-investors, whether it's in a husband and wife situation, brother and sisters, friends, all these things got to be looked at, and also, all right, as a result of that, the tax side of things, tax filing, all these things, how is it going to impact? Now, that brings me to the last point on this slide is this capture of losses, okay, whether it is net rental income tax losses or capital losses, and how do you utilize that? Now, it is very important to understand that bit, which I'll show you a little bit later at the end when we deal with this capital gain, how you can actually do that a bit more efficiently so that when you come to sell the property, you can actually use some of these tax losses, whether it's previous year's rental tax losses or previous year capital loss, if you have previously sold some property, against the current year capital gain as a result of that. How do you offset all that? So that's become an important play in terms of offsetting, all right, which we talked about early on. Now, so obviously we talk a lot about investment, all right, in property. We talk about a lot of tax issue, but often people forgot what's the reason we all doing this, right? To start with is that we got all very excited to buy the property. We forgot all these things about capturing all the information that we need in terms of buying the property. All right. Why is important? It's like I often have client come to me and say, look, well, Albert, it's time for us to sell the property. All right. What is our capital cost? All right. I say, look, you got to keep record of your purchase price, your stamp duty, or your related purchase, costs, all right, including your foreigner additional stamp duty, your legal costs, your everything that you can think of, or everything is properly documented of in terms of your capital costs that form your cost base for the entry. So obviously that when you sell, there are things that you need to take account of, meaning that what's the selling price, what's the agent commission, what are the legal fee, what are the associated marketing. You can think of, what are the costs so that I can maximize. All right. So what you need to do is maximize your capital cost, which is your cost of your purchasing, and you're also going to maximize your your deductions in terms of all the selling costs related to the sales. Obviously, you want to keep your selling price as high as possible so that you can achieve a good outcome for yourselves. But all these things are important. If you don't plan it when you get in, very likely that when you get out, then you hit with all this capital gain. You say, look, well, have we maximized our position? All right, meaning that have we maximized our capital cost? Have we account for everything that is incurred as a purchase? Well, if you have not done yourself justice. So what we do here at GC and Associate is we help you with that. All right, but it's got to be from day one. All right, I hate taking over a client that previously was with another accountant and they had lost all their records and all these things. So what we always encourage the client, do this at start. All right, plan it properly, work out what you need to do, exactly what you need to do. We have a very comprehensive checklist in terms of gathering all this information. And now with the convenience of soft copy, you can store in your hard drive, or we have a very special storage here that we can keep all the information together and know what is your cost is so important. All right. Now, this thing, the second item that we always talk about with client is making sure your yearly accounting, your tax filing is up to date, absolutely up to date, including capturing all the tax losses. All right. Basically the rental tax losses, the net rental income, meaning that, if you make a loss, you capture the loss. All right. If you have sold a property previously, you have captured the capital loss. These losses, you don't just lose it like that. These losses can be called, carry forward indefinitely. All right. So you got to make sure that you have all this information very readily. Now, again, at the end of this, seminar, there's this section, big capital gain discussion about all these are relevant, become all relevant is to work out your net position. When you sell the property, are you able to have your losses being captured previously, whether it's net rental losses or capital losses from previous sales of property? Are these available, easily available? Then you understand why I make a big fuss out of it now. Okay, let's deal with some figures. All right, now this tax rate here is for foreign resident, foreign tax resident, or we call non-resident for 2023-24, which is 2024 tax year. 0 to $120,000, 32.5% for each dollars. You can see, like, if I earn up to, let's say, $100,000, so about a third of them has gone away. All right, a third of them has gone away. All right. Now, of course, the more income that you earn, progressive, you pay more tax as a result of that. Over $180,000 is a 45%. All right, which is quite a lot. All right. Now, the good thing about it is that there's some changes coming through, which is quite positive, but I don't think it's enough. But again, now they have looked at you can earn 0 to 135,000 at 30%. All right. I'll talk a little bit about that later on. Anything up above $190,001, it's at 45%. So there's small little changes. If I can just bring it back to you again, the previous one, you can see, right? 120, 0 to 120, from 120 to 180 is 32 jump to 37. And then from 180 onward is 45%. So if you look at this next slide, so it's 0 to 135. So there's a small adjustment. It's around $15,000 more. Okay. So the top end, which is the 180, hasn't really changed that much. There's only $10,000 adjustment. Now, why I think that is important is this. All right. Remember, we talked a little bit earlier about this joint ownership. All right. When you split the income, all right, we'll talk about ownership structure. Joint ownership or tenants in common, it doesn't matter. So basically, because of that core investment with more than one person, okay, means that two or more, is you basically split your income. All right. Now, this is important. All right. And I mentioned this to Brian yesterday when we were doing this discussion, is all of a sudden that if you think about, if you only own this property as a single property owner, so anything that you earn, including capital gain, all right, up to 135,000 in this case, in this current tax year, you're paying 30%. All right. But if you do this as a joint investment, meaning that more than one person, or whether it's joint tenancy or tenants in common, you basically have the opportunity to split the income. All right. Each person is entitled to up to 135,000 and pay 30%. So all of a sudden that you realize that, so for joint person, each person is 135 maximum to pay 30% tax. So I really need to earn, if the property including capital gain and net rental income is 250,000. So effectively, I'm still at 30%. But if I do this as a single person, I'm already on the 45% already. Just very basic thinking. So these are the things that you need to think about. Now, what I'm going to do is to show you this corporate income tax and what relevancy in terms of the previous slides. Often I have client, this has been talked about for a number of years now. Is client often say, look, well, if I look at the individual tax rate, okay, the starting point is, bring 2 slides backward so that you can make some comparison. If I am what we call individual, all right, foreign individual, all right, non-tax resident. So effectively, I'm on this sliding up tax rate, all right. So it's progressive, right? So if I'm a company, I'm at 30% flat, all right. So I don't pay more than 30%. So effectively, it's just locked in at 30%. Doesn't matter how much I earn. If the property are locked into a corporate or a company structure, I'm paying 30% flat in terms of the net income. So all the deduction, reporting of gross income, tax deductions, including interest, depreciation, very much the same. The rules are the same. It's just the ultimate is the net income, all right, is I'm concerned about. The net income, assuming it's the same, all right, for a company, for individual, in terms of the tax, it makes a difference. Now, that was before, all right? Now, it's actually changed a little bit, at least on the current year. You know, you still can earn up to 135,000 net income, including capital gain, all right? 30%, all right? Of course, because it's individual, as you go up above the 135,000, it's actually more. Now, I can understand that. And this is why that people choose to use a company, all right? Because it's flat, all right? 30% flat. Now, there's a lot more with it in terms of having a company or having the property being captured under the company structure. There's a lot more you need to know, all right? It's not as simple as just the tax rate. There are other complications you need to be aware of, such as yearly financial reporting. In Australia, small company, small medium-sized company doesn't have to be audited. So we don't have this audit requirement, such as Singapore, compared to Singapore. In Australia, it's a lot more straightforward, but you still need to do your standard financial reporting. You still need to do your company tax return, which will ultimately determine what income, what is the deductions, net income, what's taxable. So if you thinking about going down this track, please, we can have a separate discussion on that, how to do all that under a company structure, even the own property under a company structure. That can be discussed. Yeah. Okay. I'll spend some time talking a little bit about this land tax. It's a very complicated topic or complex topic. In most of the states in Australia, I'm talking about all the states, all right, including Western Australia, which is include Perth. We all have land tax, all right, but because land tax is what they call a state tax, so each state impose different rules in terms of how they tax land tax or how they tax land. All right, so basically it's a complex issue. It's not a federal system. Income tax is definitely a federal tax, but land tax is a state tax. Each state will have their own rules. All right, now today I'm going to talk about the two states being Victoria, which is Melbourne, and then the other one is New South Wales or Sydney. All right, I'm been told specifically for these two areas. I previously have, in a different seminar, had talked about land tax in Western Australia. I'm happy to share the information if you write to me about that, or you can contact Brian, and I believe that we can supply the information as well. Now, just on the Victorian land tax, all right. Now, land tax is levied based on your actual ownership, whether it's individually, whether it's joint, at the 31st of December. So every year at the cutoff of 31st December, they work out a ownership at that time, and then they work out the land tax is due for the following year, which is from 1st January, right? So in this financial year, this year's land tax is the 24 land tax, meaning starting from 1st January 24 to 31st December 24. All right. Then it works out the land value, it works out the land tax liability you have to pay. Now, it deals with land only. It doesn't deal with what we call improvement. Okay, meaning say they only look at the land value. If you put a house on it, they don't look at the house value. They look at the land value only. Okay. Now, there are certain exemption on the land tax. So typically, family home is exempt from land tax. We call the PPR, means principal place of residence. That's exempt. And so some primary production land, farmland basically, is exempt from land tax. Now, the other client asking me, look, I know this land tax, what happened that, I get this thing, from the tax office about this vacant residential land tax, scratching their head, right? What is that? All right. So it's actually not land tax. It's a different thing. All right. It's still a tax on the property, but it deals with property that are unoccupied for more than 6 months. All right. For more than 6 months. All right. That's where it's been left vacant. So if you want to know how much they're going to levy that, it's 1% of the capital improved value, CIV. All right, now that's quite a lot, because when you think about it, when you have a property, you have the land component and you have the capital improved value, meaning that the building and the fixtures and everything else. It's a two separate things. So they're talking about capital improved value, meaning that the land and the building together. All right, that's a lot. All right, the land value might be a portion of the overall value of the property, but 1% on the total value, that's a lot of tax to pay. All right, now 6 months is the key date, meaning that if the properties are unoccupied for more than 6 months, it's deemed to be vacant. All right, now you got to be very careful with that. Is you have to pay vacancy tax for that. All right. It's 1% of the total value of the property. Okay, now the other item that recently that a lot of people ask me is this, like, Albert, I heard about this, this absentee owner, an absentee owner surcharge. What's that? You know, um, so this is what we call the other layer of land tax. All right, now why I say the other layer, meaning that you normally all the landowner, including the Australian resident, we all pay land tax, okay, except our family home. All right. So say for example myself, I will not pay land tax on the family home that I live in or I stay in, but I can only have one as my PPR, okay, principal place of residence, they're so called. But if I have more than one of that, meaning that the second property most likely is going to be an investment property. It could be a rental property. It could be just a property that not occupied by me, but owned by me. I pay land tax on that. All right. So everybody pay land tax on not their family home, but other property they have. All right. Now that includes company, that includes individual, like you and me, including trusts and all these things. So again, land tax is one thing, absentee owner is another thing. Now, I'll give you the definition. All right. When I get asked this question many, many times. All right. People say, look, what do you mean by absentee owner? All right. Now, in front of you, this you can read it for yourself, right? So the first thing item is that, look, you're not a Australian citizen or permanent resident. All right. So you're considered as an absentee, number one. Two, you don't reside in Australia. Normally you don't reside, meaning that you don't stay here, you don't come into this country and live here. All right. You're considered absentee. And or if you are absent from here for more than 6 months, all right, and you are considered absentee owner. Now, normal standard client that who been living in Singapore, tax resident of Singapore, citizen of Singapore, permanent resident of Singapore, they are not living in Australia. This property they own very likely is for investment purpose. Therefore, they don't live in the property. They are not considered as their PPR. And obviously, by right, and you can see very strict definition is absentee owner. All right. And therefore, absentee owner surcharge, which is the other layer of land tax, has to be paid. All right. Now, we started off paying, well, not we, my client from Singapore or what calls absentee owner started paying this absentee owner surcharge from 2020 land tax year at 2%. All right. And that's been increasing. All right. Now, I'll just bring you this next slide. So this 24 year, this year 2024, this year from January onward, things have changed. All right. So it actually has changed. The absentee owner surcharge has changed from 2% to 4%. All right. Okay. That is a lot. That's like basically double. All right. Okay. On top of that, other than the absentee owner surcharge, there's this land tax changes as well. They have this COVID debt repayment plan, meaning that the Victorian government had overspent the money during the COVID lockdown period. The budget is, ruined, meaning that they have destroyed the budget. Okay, now they have a lot of debts. They're getting the property owner to pay for it. All right, the land tax threshold have changed substantially. All right, used to be before this 2024, if you own a property, say for example like house and land, the land is less than 300,000, you pay no land tax. Okay, because you pay no land tax as a foreigner, you also don't pay any absentee owner surcharge. The only time you have to pay land tax for foreigner before 2024 is whereby your property is more than 300,000. All right. And therefore, because you pay land tax, because your land value is more than 300,000, therefore you pay absentee owner surcharge. And it's at 2% of the land value. Now it's totally different. As you can see in front of you, the taxable land holding that you have from between 50 to 100,000, you pay $500,000 flat land tax. But because you pay land tax, you have to pay this absentee owner surcharge. So that's how ridiculous it is at the moment. But anyway, law's been law, so we really can't argue with that at the moment. Is if the next thing is 100,000 to 300,000, you pay 975. Okay, anything more than 300,000, it's 975 plus 0.1%. Okay, an increase. So there is a land tax calculator that you can use, which I encourage you to do that with the SRO Victoria. You can go in there, you can plug in your land value, you can work out what the land tax. Just make sure that if you are absentee owner, you're going to click the dot for being an absentee owner. Then the absentee owner surcharge will kick in as well. You can work out that position for you as well. So again, I think the land tax calculator is very, very useful. Have a crack at it. If you have any problem, you can always contact me. Anyway, all right. Now, I want to run through this New South Wales land tax as quickly as I can as well. Very similarly, again, New South Wales land tax, is stat tax administered by the New South Wales government. Their rules are different, but they are something in common. Okay, something in common means that land tax is paid on the land value. All right, so there's threshold again. Your principal place of residence (PPR) is exempted. Family home that you have, if you decided to call New South Wales in Sydney home, you buy a place for your own use, that's exempt. Your property, family home, don't pay any land tax on that. All right. Now, their threshold is slightly different from Victoria. Okay. Now, as you can see in front of you, land tax threshold in New South Wales is quite high. All right. You see 2024, the general threshold for land tax is over $1 million. All right. Now, you only pay land tax if your land value is over that. All right. And I believe most of my clients who owns property in New South Wales as an investment, most of their land value is already above that. All right. So they pay a lot of land tax. I remember I have a client who has a property, his dining hall actually looks towards this Sydney Harbour Bridge. I think it was $4.5 million. The land value is about nearly $2 million. All right. and obviously he's hit the threshold, so he has to pay land tax. On top of that, he has to pay this absentee owner surcharge as well. So that same rules apply. All right, same rule apply. Okay, and all right, I won't go through this, but you know, just quickly. Okay, same thing, 31st December. So New South Wales absentee owner is surcharge is the same. All right, but there is slight difference in terms of absentee owner surcharge. In New South Wales, if you own the property, you don't have to pay land tax because your threshold is below because your land value is below the threshold. You don't pay the land tax, but you have to pay foreign person absentee owner surcharge. All right, it's slightly different. All right, Victoria means that if you don't pay land tax, you don't pay absentee owner surcharge. All right, but because of the lower threshold in Victoria, in terms of the land value, you basically pay both. But in New South Wales, it's different. Say, for example, if you have property that the land value is below the threshold, the 1,075,000, you don't pay land tax, but you still have to pay absentee owner surcharge. All right. So obviously, if you pay land tax, you still, as a foreigner, you still have to pay absentee owner surcharge. There's the slight difference on that. All right. Okay. That again, their definition is slightly different again in terms of foreigner. They remove the word permanent resident. Okay. In this case here is that you have to live in Australia for 200 days or more. So their definition are very different from Victoria. And they do have other things, this international tax arrangement. And now you don't have to pay land tax or foreign owner surcharge if you are a citizen of New Zealand, South Africa's, Germany. I mean, if you from those countries, if you are a citizen of that, you may be able to apply for exemption from this foreign owner surcharge. All right. So again, it's still 31st December. All right. Just be aware of that. All right. Yeah. So the surcharge rate. So surcharge rate for foreign absentee owner, foreign owner, used to be 4%, used to be 2%. All right. I mean, it's 0.75 from 2017, increased to 2% in 2018, and from last year's already 2013, 23, already at 4%. So it's at par now with Victoria now. Okay. So the only state that, if I can just make a different comment, the only states that I know hasn't got this absentee owner surcharge is only Western Australia. Okay, that's the only state I'm aware that hasn't got it yet. But please write to me if you are going to look at that and you want to get a confirmation. I'm happy to look into that for you. But from memory, Western Australia, Perth, doesn't have this absentee owner surcharge, but they do have land tax. Okay, just got to be aware of that. Yeah. Okay, I think with the final runs in this a bit more specific topics in terms of taxes, capital gain is definitely something that is important for people to know if they want to buy and hold and maybe later on thinking about selling. So how do you deal with that? All right, but I'll just run through this again in terms of the concept of capital gain. Now, often people say, look, we don't have capital gain tax in Singapore. So the other place that I'm very aware of is don't have capital gains tax is New Zealand. All right, but New Zealand, the rules, even though they said they don't have capital gain, but they do tax another way that I still think that is capital gain. All right. Is they do this thing called the recoup of the depreciation that you have claimed because you're not paying tax. So this basically this depreciation has to be added back. Potentially they will tax you on that. So it's still another way of looking at things a little bit differently. But again, in general, in Australia here, you pay tax on the profit that you make by selling the assets, especially property. All right. Exemption, yeah. So people like to know, everything is taxed, but what is not taxed? All right. So again, there's two things that I can pop up into my mind is this pre-85, well, it's actually any assets before that. Okay. Capital gains tax brought in, 19 September 1985. So any things before that is what they call pre-CGT, pre-capital gains tax period. So therefore, it's not taxable, it's exempt. And obviously the family home, the PPR things is still main resident, family home, not considered as taxable under this capital gain regime. But what about foreigner? Okay, this is something that you need to know. All right, the rule have changed a fair bit. Okay, originally they said before the rule changes in 2019, foreigner are allowed to have a main resident, meaning that sometimes they buy a property, they put their children here, they claim that as for family use, for own use, family home. Even though we are not tax resident in Australia, we're allowed to have a main resident in Australia while we have been Singaporean resident or permanent resident or citizen. But the rule had changed on 12th of December 2019. All right. So what they're saying that, look, from then onward, you are not allowed to entitled to claim main resident exemption from capital gain if the property is sold after 30th of June 2020. All right. Unless you satisfy certain tests. All right. I won't go into the test. I'll leave that in the notes. But if you want any clarification on that, you can talk to me about that. But this only apply for people that probably already have the property for a number of years, and they get to the stage that the children are still staying there. The property hasn't changed hand to the children, but they are thinking about disposing. So there are so-called tax implication as a result of that. All right. What if you do this? What if you do that? So all these things you need to get proper advice. All right. But the rule says, if you're no longer a tax resident in Australia or Australian resident for tax purpose in Australia, you are no longer entitled to this capital gain main resident exemptions. All right. Now, what I'll do now, this next few slides is probably a bit more mechanical. All right. Is how do you work out your net capital gain or loss? All right. So again, it's not every time that you talk about gain, right? Sometimes you talk about loss. All right. But people don't want to talk about loss because they always believe that if you buy a property, it's a good property, it should make some gain. All right. But we cannot always assume that. Importantly is how do you work it out? So you have a situation whereby if you sold a property, if you do make a capital gain, it's so-called capital gain for the current year. All right. But if you make a capital loss, it's capital loss for the current year. Right. But if you do make a capital gain, you have to take account of, number one, any capital loss that you have made in the same year. All right. All right. Because that can be offset against the capital gain in the same year. Then you also have to take account. This is in order. All right. This is in order. So you don't jump around that. This is 1, 2, 3. You must follow the order. Capital gain, capital loss that carried forward from previous year. All right. So that's part 2. We got to do that. Step 2, right? We call step 2. Step 3 is to apply for any general capital gain discount. All right. Now this is important. All right. Now people will say, look, I didn't know there's a discount. I say, yeah, you are allowed to have a discount. I'll explain to you a little bit. That's where you net it out. I say, look, if you have that, you take out this, take out that, then that is your net capital gain position. Then you tax it together with your other income. Now I say, look, Albert, stop there. I'm interested to know whether I'm entitled to the general capital gain discount. What's that? All right. I didn't know there's such thing, right? So before, this is many, many years ago, I mean, foreigners are enjoying the same, I would say, benefit of this 50% capital gain tax discount. Okay, but the rule have changed. Again, the rule changed. All right, after 7th of May 2012. All right, meaning that you have any assets that you own before the rule change. Okay, you're still entitled to that 50% discount. All right, so if you come to me and say, look, well, Albert, I have a property, I bought it in, I don't know, the year 2005, I still have it, but I'm thinking of selling. All right, what are the so-called capital gain tax considerations? Like, what are the things that I need to look out? All right, so back to the same slides again. Is, am I entitled to this? What's my capital gain this year? Or capital loss the same year? Capital loss previous year means that I previously sold a property. I know I make a capital loss, but guess what? I haven't done my tax return, so I don't know how much it is. So that's important. You got to find out. All right. Of course, the last item is, oh, I'm entitled to some sort of capital gain tax discount. So this is where it is. All right. Is you get the advice. All right. Then you got to work. We got to work it out for you. What are the so-called the discount you're entitled to? So I think one of the things that we will need to do is to ascertain a market valuation. All right. Now this is the proper tax, valuation for tax purpose. We call, all right, for capital gain purpose, to capture the value up to 8th of May, meaning that you are allowed to claim any discount, all right, capital gain tax discount from, say, you buy the property in 2005 and you got a valuation done 8th of May 2012, all right, and you work out the capital gains position on that, you get the 50% discount. It's not taxable, all right, for that few years, all right, 2005 to 2012, 8th of May. And then the rest will be taxed 100%, all right, full assessment on that. So these are the things that you need to watch out, all right. Now, the big one come, all right. So again, these are all of the doing of the Australian government try to improve their position in terms of foreigner investing in Australia. Some of them, I'm not saying all of them, has failed to report their capital gain, all right? And the rules has come in to stop all that, all right? Meaning that from 2016 onward, they have introduced this thing called, basically it's a withholding tax. It's a foreign resident capital gain withholding. It's a system where they implement and say, look, well, if you sell your property, all right, you are considered as a foreign tax resident, you will be subject to this, all right? Now, I think at start they were talking about 10% over $1 million. I think very quickly, within a year, they changed their mind, okay? Basically, they said, look, well, from 1st July 2017, it's 12.5%, threshold is 750, all right? Now, this so-called withholding tax is actually taken out when you actually at settlement, all right? So it's removed from the proceed of the settlement, all right? Now, because this is a withholding tax, this is not the final tax, meaning that you don't forego the tax. This is become a credit to you. Now, I'm going to run a few examples, but I'm going to do it quickly so that it's not too long, all right? Now, first example, all right, contract price is 650,000. As you know, it's below 750. The capital gain withholding is zero, all right? No, zero, right? Don't need. So say, for example, the capital gain is estimated 80,000. You got other income, such as the net rental income, you got 20. So your total taxable income is 100,000. So 32.5% up to 120,000. It's at 32.5, it's 32,500. You have no credit in your capital gain withholding, so you have to pay 32,500. All right. Now, it's slightly different now when you look at example 2. It's 800,000 because it's above the 750. So 12.5% kicks in. So the 100,000. All right. So 12.5% of 800 is 100,000. Say, for example, the capital gain on the sale of property is 100, taxable income is 20,000, total taxable income is 120. Okay, so you get capital gain 100, you got your net rental income is 20, 120. So again, you are that 32.5%, so it's 39,000 taxable. So because you have that foreign resident capital gain withholding of 100,000, so you're actually getting a refund of 61,000. All right, so credit tax payable is 39, credit 100, 61,000 is what you're going to entitled to in terms of refund. Now, when we deal with something else, remember I talked a little bit about what if you have carried forward tax losses, right? Remember we talked about that, depreciation, borrowing costs, and all these things. Say we factored that in, all right? I mean, not on purpose, but if you're in this scenario, you say, look, wow, my selling price is still 800,000. Capital gain withholding is 12.5%, 100,000. My capital gain is 100. All right. My other income in terms of the net rental income is 20. But I do know from the last few years, leading up to my selling of property, I have accumulated some net rental tax losses. All right. 100,000. I can use that to offset. All right. I think I mentioned this before early on. You can use that. All right. You can carry forward your net rental income losses indefinitely. All right. So you can utilize that losses. So 100 plus 20 minus 100, your taxable income become 20. So 20,000 at 32.5 is 6,500. You have your foreign resident capital withholding, $100,000 credit. You're getting a refund back of 93,500. All right. So this last example is actually a bit more comprehensive, but I'll just give you this example. It's because I'm going to explain the next slides. Is your selling price now is $1 million, say for example, 12.5% apply. But because you can predict in terms of your taxable position as a result of these sales, as a per below, which I'm going to explain a little bit, you come to me and you say, look, wow, Albert, our tax return is up to date. We know our previous year carry forward losses. We know our capital loss because I previously sold some property. I've carried forward all these losses. I want to use them. Can you work out the position? And I come back to you with an estimate and say, look, wow, yeah, you are in this position. You don't have to pay any tax as a result. So we should vary your capital, foreign resident capital withholding to 0. So we did all that. So assuming that we now got to the next step and to do your proper tax return, we work it out. Capital gain is selling a property is 150. Your other income from the rental is 30,000. So that is 180. You got your previous year carry forward capital loss 100 from the previous year sale of property. You also got your tax losses of net rental income carry forward from the previous year 100. So you got 150 plus 30 minus 100 minus 100. So effectively, your taxable income is 0. So actually, you are still left with $20,000 of losses. Or in this case, is your net rental income losses, which you still can carry forward. Your taxable income is 0. Tax payable is 0. We already vary your capital gain withholding from 125 to 0. It's credit 0. Tax position is 0. But imagine thinking about that. If you haven't done all that variation, you would have withheld that 125,000. All right. So this is the so-called scenario. Now, I want to do this properly. So I'm telling you that when you do sell your property, often your lawyer is going to come to you and say, wow, it's coming up for settlement in 30 days. We're getting it ready. All right. I need you to apply for your clearance certificate. Now, one thing I can say to you, I've seen this too many times. Lawyer, they don't know who they are dealing with. They don't know who they probably know you're a foreign tax resident. They still come to you and ask you for this. Definitely as a foreign resident, you're not qualified for that clearance certificate. All right, definitely not qualified. All right, but you are maybe qualified for this variation in terms of this capital gain withholding. All right, but you need to do this 28 days before that, before it settles. All right, because we have to go back and present a case to the tax office and get that variation going for you. All right, don't come to me and say, look, wow, Albert, settlement is next week. I want to do it now. There's no way it can be done. All right, not if you haven't got all the record up to date, including your previous year tax filing. All right, now again, tax filing up to date. All right, have to be up to date. You got to know your previous year carry forward losses. You got to know your carry forward rental losses. Then we're going to work out your capital gain, in this case for your sales. Now, we have done this so many times with our client. We keep telling the client, it's got to be done. It's got to be up to date. Especially you have the intention to sell the property. You should get everything up to date. All right, so we can work out the position for you. All right. Now, this is the last lot of this so-called capital gain. All right. Now, this is not law yet. All right. Now, I'm telling you that from next year, January onward, 1st January 2025, the rate have changed. All right. The rate have changed to 15%. All right. So it's 12.5, now become 15%. And they're going to remove the $750,000 threshold. All right. Meaning that everything that gets sold in terms of Australian property from $1 onward, or from $1 onward, are all subject to this 15% withholding tax. All right. Now, it's not in law as yet, but it's already out there. All right. And the government are pushing through that legislation to get it changed. All right. Now, that's what you're going to be aware of. Now, let's just do a bit of housekeeping, tidy up. All right. Tax filing, again, very important topic. Our financial year or tax year, 1st July to 30th of June. All right. If anybody going to do their tax filing themselves, they go until end of this month, 31st October to do it. Otherwise, they deal with a tax agent. All right. We have extension of time, but we need to be on board. Now, there's a lot of changes in terms of onboarding client. All right. And get it done early if you want us to be involved, because once you're on our what we call tax agent list, you are effectively let's get this automatic of extension of time. All right. Now, what's best or example for you to go through this? If you're looking at contracting in October this month, the application of tax file number should be in as early as next month. All right. Now it takes up to 3 months just to get a tax file number. All right, because there's a lot of scrutiny going over in terms of identification of ID and everything else. All right. Now, assuming that the property settlement is December 2026, first rental received is January 2027. Your first tax return is 30th of June 2027. And you got about 6 months to do it from 1st July 2027. All right. Now, how do you get things going? All right. Need a couple of things. First thing, you need to appoint a tax agent. You can appoint GC, happy to help you with that. Then there is this client detail that you need to complete. Then we get onto your tax file number application. Again, it's a very long process. We need to have the tax file number application completed correctly. All right, there's 2 form ID, the passport and your Singapore IC. All right, both of these documents has to be certified at the Australian High Commissioner in Singapore. Or if you're coming down to Australia here, do pay us a visit in our office. You can get it done at the local Justice of Peace. It's free of charge. I mean, that's another way to look at it. Then obviously importantly is the tax depreciation report. One off again, there's checklist we can help you with. You can have a look at that and get your things in order. I don't think there will be any question, but if you do have, happy for you to bounce it back either to Brian, and you got my email address. That's the office website. You can send it through the email address there. I think that's about it for today. Thank
Thank you.
you.
Thank you so much again, Albert. I'm sure that it was so informative, actually, about information. I do have a quick question, though. You see whether you can help me with this question. So now, I understand that the filing of tax file numbers do take some time. Now, what if it's an existing client right now and they do have a tax file number, but they got their tax file number when they were strawberry pickers 20 years ago when they were traveling to Australia, but they can't remember what's their TFN now, basically. How would you help in this situation,
Yeah,
basically?
that's a very good question. In HLA, we have a lot of clients that we dealt with that. It's actually a very difficult way to deal with that, because usually if the tax file number hasn't been used for a number of years, they can be so-called they put a stop to it. All right, meaning that if you want to, if even you can find that number, if you want to onboard it, we're gonna have some difficulty trying to do that. Now, the alternative way to do that is for the client to call up the tax office. Now, I don't encourage the client to do that because they can be put on hold for 2 hours. All right, it's they put it in your queue, and I got client from Singapore call up within like half an hour, they give up already. Okay, now there is another way to get around that. Effectively, is to submit a new application in. So the application form has two functions. One is apply for a new tax file number. The other function of the same application form is actually to inquire, which you basically reinstate your IDs and everything, so they can do a reproof your ID. Basically, what they will do is that they will issue you the same number. So they need to re-ID you on that. Yeah. So that's a very good question. And I have client, we have done that, redo the application, send it in, they'll call up, we'll try to verify and say, look, well, this client previously says this number, but we won't show whether it's still active or not. So the word is whether it's still active or not. Again, ending more than 10 years, I think that it will be very unlikely to be active anyway. Yeah.
But you'll be assisting them throughout the entire process.
Correct. Yeah. We'll do the same thing anyway, what we normally do with all our
Right.
clients. Yeah.
So like I said, I've worked with Albert for more than a decade, and it's really helped many of my clients. I think we hope that you continue to help many of our clients in the decades to come as well. So with that, I think I will end this meeting. Just remember, if you want to talk to Albert, obviously Albert has his contact details, or if you want to get to know Albert and have his questions answered for you or your clients, you can always feel free to reach out to any of our taggers. We're all in contact with Albert. So we'll see you at the next exhibition, and we'll also have Albert come down to support one of our events one of these days as well. So thank you so much for coming online. We hope you found the session informative, and have a lovely day. Thank you. Thanks, Albert.
Thank you. Thank you, everyone.